Hey, good morning, everybody, and welcome to this Tuesday, April 29th, 2025 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with you all again this week. Interesting action in the market, obviously. We've got the S&P 500 moving all the way back up to its trading range that I've talked about, 4,800 to the downside, 55.21 to the upside. We did close on Friday at 55.25. Went back down below that yesterday throughout much of the day. And in the afternoon, we rallied back right up near that 55.21 level. I wouldn't say that we've broken out of the range at this point, even though we did close Friday 4 points above. And we were doing a lot of trading just above 55.21 into the close yesterday. But, this is at least the first step. We can't get through the level without at least getting up to test it. So it's been a good past couple of weeks for the bulls coming off the lows. If we can get this breakout here, I think that might be the final straw, in my opinion, that would confirm the bottom is in. I think the bottom's in anyway. Again, could we go back down one more time and maybe take out that 48.35 low that we had a few weeks ago? It's possible. I wouldn't rule it out. The market does like to do that from time to time. You set a low on high volatility and then go back down and you take it out, just barely. Triggers a lot more stops and then move back up to the upside. So it's possible. We've still got obviously a number of things that are uncertain as we move forward, namely the tariffs, interest rates, the inflation outlook, and so forth. Personally, I think a lot of it's been blown way out of proportion. I think the market is trading like that. A lot of money recently rotating back into aggressive areas of the market. One of my favorite ratios, which I'll show you in a little bit, the XLY versus the XLP, which is consumer discretionary versus consumer staples, has absolutely exploded back to the upside off the March low. So there's a lot going on that I think is really solid. But let me go ahead and pull up what happened on Friday. We'll get back. I'm showing you this XLY, XLP chart. Just kind of wet your whistle there a little bit. But I want to go ahead and talk a little bit about what happened yesterday first. So if we zero in here, you can see that the Dow Jones Industrial Average finished up 114 points. That was a little bit more than 0.25%. S&P 500 up just fractionally, but it is a second close now above the 55.21 level. The NASDAQ lagged throughout the day, but did come back pretty strong late in the day, finishing down 0.1%. Mid caps and small caps did pretty well on a relative basis, both finishing above 0.33% increase. And the VIX actually went up a little bit with this, what I would call moderate or maybe not even moderate strength in the major indices. But the volatility index did move up, and it's at a key level right now. This is about the same level we were when the market broke down below the 55.21 level back in early April. We had the gap downs and we went down for about 3 or 4 days really hard. The VIX was about 25 when that happened. So we've gotten all the way back. Now we're back to 55.21 and we're right back to where that VIX was on that breakdown right near 25, or breakout, I should say, near 25. So this is an interesting time for the market. I'm not going to try to predict whether we get through here or not. I just think it's important to see whether we do. And then if we do, what kind of leadership do we get on this move through a key resistance level? Do we see the growth stocks leading? Do we see a more defensive move to the upside with a breakout? I think that would be a pretty important signal to follow in determining whether or not this period of consolidation and weakness is ending. But I can't predict. We have to see what the market tells us on that. But again, I am very happy that the market's been able to get back to the upper end of the range, back to that 55.21 level. And now we'll see where we go from here. The 10-year Treasury Yield, been watching this a little bit. We're at 4.218, so that's 4.22%. We've been steadily declining again on the 10-year Treasury Yield. And again, if you're out there arguing for, maybe a inflationary surge or something, bond market is not calling for that at all. I just don't see it. So I know a lot of folks, and that's why I think that a lot of this has been overblown. Hey, I don't know what's going to happen with tariffs. I don't know if the tariffs are going to go shooting higher again. Another week, 2 weeks, 3 weeks, or after the 90-day pause. But I do look for signs in the market to see how Wall Street is trading. And when I look at the bond market, I just don't see inflation in the picture. You would have a lot of selling of bonds. Who would want to be in bonds yielding 4.22% if you believe inflation's about to surge again? Inflation right now is at 3%, a little over 3%. And I'm talking about the core CPI annualized rate. So we're already over 3%. I mean, would you buy a 4.22% 10-year Treasury with inflation already over 3% and thinking that it's going to go much higher? Well, bond market, that's not the case. See a lot of folks still buying bonds. So that to me says that inflation is not a big concern in the bond market, even though it seems to be every time we hear from the Fed. So I think all that's going to pass. I think the Fed's gotten things wrong quite a bit over the last few years, or they've just been late to the party. I think this is going to end up being one more time when they're late to the party. I think their next move is going to be a cut. I don't know when it's going to be, but I believe they will be cutting. And I think that will certainly help the market at some point, either later this year or into 2026, move back to all-time highs. Let's take a look at the S&P 500 so I can show you exactly what I'm talking about in terms of this range. I'll shorten this 1-year chart down to about 6 months so that we can get a little bit closer look. So as we were moving down, we've talked about this before, but we had the 57.82 gap support and this 57.82 low. We broke below 57.82 and we came right back up and tested it. I can put this line in here just to kind of show you visually what that looks like. Here's the breakdown. Here you go back and retest it. This is nothing more than technical analysis 101. Broken support becomes resistance. It's like you're on the second floor of the building and you break down below, you go down to the first floor. That floor on the second level becomes your ceiling on the first level. So when you break down, you go down that elevator to the next level. Now all of a sudden this becomes your ceiling instead of your floor. Went right up, we tested that, and then broke back down below 55.21. Well, now instead of being on level 1, maybe we're on the ground floor, we're in the basement, whatever. But now level 1 becomes our resistance. It was our floor. Now it becomes resistance. We're sitting right on it. So, we could have thought back at the end of March, okay, we're going to go right on through, but we didn't. We ended up rolling back over and eventually we lost the floor. Here, we're kind of in that same predicament. We've moved through the 20-day moving average just like we did before. Could not get to the 50-day moving average before. We haven't gotten to the 50-day yet. There's absolutely a technical chance that we roll back over here. So it's difficult to get too aggressive when you're sitting right against resistance. That's not the best time to buy. Right now is not the best time to buy because, again, we could roll back over again. And if we do, that buy is going to turn into a lot of pain. So I think you got to get at least the breakout, because if you get the breakout, and notice the 20-day moving average is rising here. Since the end of February, when we topped and we broke down below the 20-day, we've struggled to stay above the 20-day. And the 20-day, for the most part, maybe right here, we tried to turn up a little bit, but we really never did, and then kept going lower. This is the first time really where we've had a clear move back to the upside in the 20-day moving average, which means that we've remained strong for a longer period of time. That's how you get back up above the 20-day and you get that 20-day to rise. A lot more of the action has to be taking place up near the 20-day or above the 20-day in order to get that moving average to start to turn back to the upside. So there are definitely positives on this chart I see, but there's also signs to be cautious. So anytime you get back up against a major price resistance level like this, we've gotten through the 20, but we haven't gotten through the 50. All of those things are something, things that we need to be aware of, somewhat concerned about. I do like a lot of the beneath the surface signals that I've been getting over the past few weeks. I've shared our manipulation Excel spreadsheet with our members, our annual members, because that was some research that I had done that I thought was starting to paint a much more bullish picture, and I wanted our members to see it. I did the same thing back, I don't think I shared the information, but I did the exact same study back in 2022, right before the market bottomed in June of 2022. And it was one of the big things I kept talking about was that market makers and Wall Street were happily buying shares after gap downs. And what we saw in 2025, starting in February through March, all of this was pure selling. This is what I call the distribution phase. I mean, we had gap downs, we had morning selling, we had afternoon selling, and it just was not a very good period for the market. That was pure distribution. Since then, it started to get a little bit better, and we started to see some bright lights or brightening lights maybe in the second half of March into early April. And then we had this last swift drop where we saw the VIX go to 55, which was a panicked level. That's how bottoms usually form, or with panicked sell-offs, which that certainly qualified for. You can see the volume nearly doubled throughout this pattern. But notice also, while we did have red filled candles, which means that we were selling off during the day as well, much of this was on huge gap downs. I mean, both of these, here we were at probably 56.80 and opened at 5,500. I mean, that was down almost 200 points on the S&P 500 at the opening bell. And then from just under 5,400 to opening just under 5,300, that's another 100 points. So there's almost 200, there's 100. So we're probably up close to 300 points in gap downs. And then how about this one? This was a reversing candle at the bottom. But we were at 50.75 and we opened probably another 100 points down. So over 3 days, we had gapped down almost 400 points. Yet the big day of the buying occurred after a slight gap down with the biggest volume of all, and we traded up all day long. The buying was all day long, and there was no gap up. There was no manipulation back to the upside. Folks were already scared enough. They were not willing buyers at the open. So it was an easy opening gap to the downside, and then Wall Street was just buying hand over fist. That was the day that President Trump announced the 90-day pause. Or maybe just, I can't remember if that was the 90-day pause, or maybe that was just talking about, that might have been the day when the allies, he said, would just be 10%. I don't remember which day it was at this point. Anyhow, the point here is that there was a lot of intraday buying, whereas on this move down, there was a lot more gaps to the downside than there was actual selling. And so when you look at this period right here as a whole, we've actually seen gap downs that total pretty high number of points, but a lot of intraday buying. And that's what you see when you get down to bottoms or close to bottoms. And again, I'm not saying that we don't go down one more time. We saw this back in May, June of 2022. And then if you recall, we ended up going down one more time into October before the bottom was in. I mean, if you had bought in June and just held, you were fine. But we did go down one more time, and that was in October with that really bad September CPI report that we had. Remember, we had the big gap down, and then there was buying all day long. It made no sense. Nobody would have bought. The only ones buying were the ones in the know, which is Wall Street. They control much of the activity in the market, and when they start buying, you better notice. And when prices, or when money starts rotating into more aggressive areas, you better notice. If you're looking for CNBC to tell you when the bottom's in, I wish you the best of luck. I really wish you the best of luck. They're great at telling you after it's over, after you've come all the way back up to highs. But you're not going to get anything fascinating from CNBC or any of the other media outlets for that matter. So you got to watch for these signals. I said recently, I've said it a couple of times, I actually bought on these 2 days right here. It was April 4th, April 7th. I started getting back in the market. And then I sent out a message to members. I believe, well, I didn't send the message out. My partner, John Hopkins, sent the message out, but I told him to tell everybody that I was back in 100%. And I believe it was on this Friday, the 11th. from what I recall. I know it was after the big recovery, and then we pulled back again a little bit. And I said, to me, it was too big of a risk to remain out of the market. Some people are thinking it's way too big of a risk to be in the market, but we had already dropped 20%. That is, about as big a drop as you're going to see in the market for the most part. I think since 1950, we've seen 10 drops that have been bigger than, I think, 21%. That's once every 7.5 years. Doesn't happen often. And so when you go down 20%, that is generally going to be a pretty good buying opportunity. There might be a few times you get into a secular bear market, then that could be a big problem. But I have signals for secular bear markets, and they're not screaming anything to me other than to stay long this market. So I believe we're on the mend. I believe we're recovering back to the upside. Do we get through 55.21 on the first chance? I mean, we closed Friday 55.25. We closed yesterday 55.28. It's possible we go right through here, but just be aware that it could be difficult. If we do get through, then I think this 57.82 is the level. That'd be another 250 points, or roughly another 4 or 5% back to the upside. But I think 57.82 would be our next key area of resistance. 50-day moving average, there's some that would sell at that. So you got to say that also is an area to watch. But these are the three levels: 55.21, which again, we're kind of treading water just above it. Then you've got the 50-day moving average, which is at 56.25, and then 57.82 resistance. And when we negotiate all three of those, this downtrend's over. I mean, that to me would be the final straw. A definitive move through 55.21 is going to make me pretty, it's going to support my theory that the bottom is in. But can't assume it. We'll have to see if we get through. Anyway, pretty interesting stuff. What was I going to show you here? Well, we've got a couple of big reports coming up later this week, earnings reports. Got some of the Bank 7 reporting later this week. We've got Apple and Amazon both reporting Thursday after the close. We've got Microsoft and Meta Platforms both reporting Wednesday after the close. So clearly these are going to be massive reports, especially if the price action on the S&P is still sitting at or around this 55.21 level. If it hasn't made up its mind one way or the other, it could be these four reports could be as simple as these four earnings reports, because they are such a big part of the S&P 500 and the NASDAQ 100. This could give us, the information, that we need in terms of whether or not we're going to see more buyers coming in here. When I look at Apple, I can just tell you, I mean, it's pretty clear that on that rally that we saw in mid-April, we got up to about 212. And yesterday's high was 211.50. I mean, we're right there up against key resistance. So Apple, not just for Apple, but also for the overall market. What happens here? What happens with earnings? Do we get the big gap up? Do we get a big gap down? And then even after the gap, we get a big gap up. Do we sell all day long? Is this the final chance? If you're going lower, a lot of times you would use, market makers could use a good report as an opportunity to gap the stock higher and sell more Apple going into what would then later be a newer or lower low. So a big gap up followed by selling all day long, that wouldn't be a very good sign. So there's just, maybe a couple of things to look for as we head into these reports. We do have an event coming up, and it's going to be tonight. I think it's at 5:00. This is our Q1 earnings, stocks to watch. During this, I'm going to actually give you some stocks that I think have already reported really solid numbers, that I would be keeping on my watch list. If we do get another downtrend, might be able to get these stocks a lot cheaper. But based on their latest earnings report, based on their relative strength, these are stocks that I would be continuing to watch as we go forward. And then also, I'm going to look ahead. I'll be talking about all four of those Mag 7 stocks that are reporting this week, telling you what I think the charts are telling me going into the reports. And then I'm going to look out a little bit and give you other stocks that I believe could report some blowout numbers based on the way they're trading, or maybe you want to stay away from stocks because their relative strength may say something different, much different. So it's always a really fun event to do. A lot of research goes into it. But I'll give you my opinion on a lot of companies that have just reported or those that will be reporting, including Apple, Amazon, Microsoft, and Meta. So if you want to sign up for this, you do have to be a member at Earnings Beats, but you can be a free trial member. So it doesn't cost you a dime. You have to give your credit card. We can't get you set up in our system without a credit card for a paid service. But we will remind you after your trial period is over that you're going to be charged if you don't cancel. So we're not going to sit back and hope you forget about it. It's not what we do. If you don't like the service, that's fine. Everybody has, services that they can maybe deal with, and maybe others they don't do very well with. So, I understand we're not for everyone out there, but if you'd like to give us a shot, now's a good time because you will get this Q1 earnings stocks to watch webinar, which will be today after the close at 5 p.m. Simply click on that and you can register for the event. All right. One thing I wanted to talk about a little bit here is this relative price action between two different sectors. And, I was inspired years ago. I've had conversations with John Murphy. John Murphy was the CNBC technical analyst for, I think, 7 years. He's written some books. I just always related to his approach to the market, especially when he starts talking about intermarket relationships. That really inspired me to start doing a lot more research because I was already passionate about the market. I was a self-taught technician, things that I believe in, things I don't believe in, or really have never found useful, I should say. It's not that I don't believe in them. I never really found a way to use them in my analysis. Things like breadth, for instance. I'm not really a breadth person, but I love intermarket analysis. This is probably my bread and butter now. If you've been following me for the last handful of years, you probably know, I've made some pretty bold calls. I think the majority of them have panned out pretty darn well. And a lot of it gets down to charts like this. The XLY, XLP, this is an intraday chart. Well, it's intraday, and it's also, so I do this top panel where I ignore gaps. So I don't care if the XLY gap's up $2 and the XLP gap's down 50 cents at the open. I'm ignoring the gaps. I don't even care about the gaps. I have an Excel spreadsheet where I track throughout the trading day the performance of the XLY from the opening bell. So wherever it opens, that's when I start tracking it. And same thing with the XLP. And so this is ignoring gaps. And basically what it does is it's just telling us if the XLY is being bought heavier than the XLP during the trading day. So it, again, ignores the gaps. It ignores what I consider to be manipulation. I mean, some gaps occur for a reason. A company comes out and disappoints and has horrible earnings, and Wall Street and everybody else was expecting good earnings. The stock should gap down. It's not worth what it was. So that I wouldn't call that one necessarily manipulation, but there is a lot of manipulation. There is a lot of gap downs, or there are a lot of gap downs. And so I think looking intraday could potentially provide us some clues. So as we're going through here, I just want you to focus on what we have seen here over the course of the last month, maybe 5-6 weeks. We have bottomed on this intraday relationship between the XLY and XLP. And we have been moving straight back up again, which is telling me that during the trading day, there's a lot more money going into the XLY, consumer discretionary, than there is the XLP. And again, that happened as of the middle part of March. So that February 19th to March, I don't know what it was, March 23rd, move to the downside was fully supported by this ratio. I mean, we were going straight down. In other words, nobody wanted to touch discretionary stocks, and folks were buying much more staple stocks. And that's what happens in a downtrend, or even before a downtrend. We start seeing that rotation. Here, from that March, we didn't bottom in the stock market until April, what was it, April 7th, something like that. But mid-March, we started seeing during the day money being bought. And you can see right here, we went up a little bit, and then we came back down. I'm going to try and bring this in a little bit better. So right toward the end of March, we kind of came back down, but we never went to a new low. And look at what happened to this ratio during the first week of April. It was soaring to the upside, even though the stock market was getting clobbered to the downside. This is one of the reasons why I decided to start buying. It's like, why are folks rotating? Why is Wall Street rotating back into discretionary stocks when the market's going down like this? It was also one of the reasons why, when we topped in December on this ratio, look at we just kept kind of going lower and lower. And in February, before we got to February 23rd, this ratio started breaking down. And why? Same thing happened at the end of 2021, by the way, before we topped before that cyclical bear market. Money started rotating away from more aggressive areas and into defensive areas. And if you watch it regularly, you pick that up. And you, at a minimum, at least, start to scratch your head a little bit. You're like, what's going on with the market? Why are stock prices going up? But rotation is telling me things are getting more defensive. And when you start adding that to maybe a little bit of complacency in the options world, and then you start seeing the VIX creep up and maybe move up into the 20s. I mean, you start combining all that, and it's like, okay, this is way too risky to be in the market. And then we get the big drop. The market drops 20% in a fairly short period of time. February 19th was the top. And by April 7th, less than 2 months later, we were already down 20%. And it's when you start feeling the pain of that loss and then start seeing all these media headlines, that's when you start to realize as a retail trader that, hey, something's up. This is going to be horrible. And about the time you start thinking it's going to be horrible and the only thing you want to do is sell, the only thing the Wall Street wants to do is buy your shares. It's the way the stock market works. So I'm not saying this can't turn back down again. I mean, anything can happen in the stock market. There's no guarantee to anything. But it's a pretty encouraging sign. Again, you just don't go rushing back into aggressive areas of the market like that when the market is still in free fall mode. That's the last thing you would want to do. Just use some common sense. Market's getting killed. You're going to put money to work in the market. Number one, you're probably not even thinking about putting money to work in the market. But if you did, would you pick aggressive stocks over defensive? I mean, I wouldn't ordinarily. I mean, I would when I see Wall Street doing it, and that's exactly what this chart tells me. So again, when I talk about market truth, I'm not getting it from CNBC, just not. Most of the folks on there, the analysts, I call influencers. I mean, there's no bigger conflict of interest. I say it pretty often. There's no bigger conflict of interest that I can think of than having Wall Street firms manage their own money and their wealthy clients' money. That's one thing they do. Two is have a market making unit that will go opposite what the influencers, these analysts, are telling you to do when they go on CNBC. So it's just common sense. They can manipulate the market. They're doing what they want to do with their own money and with their wealthy clients' money. And then they can come on with these influencers and tell you whatever the heck they want to tell you. And then if they tell you to buy a stock, understand that if enough people are buying and there's an imbalance in demand, They got market makers on the other side doing the exact opposite of what you're doing. They're selling. They're telling you to buy on CNBC. Their market makers are selling to you. Again, that's how the market works. And it's legal. So I call it legalized thievery. And that's what we have to deal with. Now, if you're a long-term investor, this kind of stuff in the short term is of no concern. Long-term, stocks are going to go where they're supposed to go to based on their earnings growth, interest rates, the market environment. Whether we're in a secular bull market or a secular bear market, I believe in these super cycles. They're like just drafts that are taking you either higher or lower over long periods of time in the market. All of those things are what is eventually going to take your stock to wherever it's going to go. But if you're a trader and you don't understand this conflict of interest and the market maker role, they're going to steal your money over time. It's like the casino. You might go into the casino and beat them once, maybe even have a good weekend or two. Eventually, they do this because they're going to get your money. Anyhow, so it is 9:30, but I really wanted to point this out because you can kind of see here's the S&P 500 going down all the way into early April. You can see with gaps, it's going down with it. But if you're just looking at intraday, if you're paying no attention to the headlines and you're paying no attention to the gaps that result from the headlines, you can make money. And this manipulation spreadsheet that I was talking about earlier shows exactly how some of the biggest stocks like Tesla, Netflix, Microsoft, and all, how these stocks have traded in the afternoons and anytime after the opening bell, but especially in the afternoons. And it's just mind-boggling. But you could literally sit and wait for lows in the morning, buy, hold the rest of the day, and sell at the close and make money during a significant downtrend. And you don't even have to short. Maybe short at the close to get the gap down. That's what happens a lot of times during these periods of high volatility. Anyway, let's take a look at what the market's doing here. Right now, we opened up 48 on the Dow. We're down 14 on the S&P 500. So back to 55.14, still kind of treading water up here at this 55.21 level. NASDAQ down 55 points on a percentage basis. That is down. NASDAQ's down 0.32%. NASDAQ 100, which includes a little bit more of that, the high octane growth, down 0.38%. So that's the worst area of the market right now. The VIX is up another 1.8%, so back to 25.61. I think if we get the S&P 500 to make that definitive breakout above the 55.21 level, and I don't think 55.25 and 55.28 are definitive breakouts of 55.21. I think we're back in the ballpark. We'll see if we can get another solid close. Then we got big earnings coming in this week. So we got a lot. Oh, and by the way, there's also non-farm payrolls. The employment report will be out on Friday. So we got a bunch of stuff coming up. How is this all going to shake out? I don't know. But again, I would pay a lot more attention to what's happening during the trading day than I would at these opening gaps. So with that, I'm going to go ahead and leave you with it. Have a great rest of your day. Again, later today at 5 o'clock, going to be talking about some of these stocks to watch based on Q1 earnings. Hope you can make it. If you're not already a member, go over to earningsbeats.com and just simply click on this link, register for the event, start a 30-day trial. It's free. If you don't see anything or you don't really not getting anything out of it, I mean, you'll have our everyday market guidance for the next 30 days. This is probably going to be a pretty critical 30-day period that we're going through. So anyway, check that out, and hopefully I'll see you at tonight's webinar. Have a great day, everybody. Happy trading.